morning, everyone. I'm Vinny Civitello, Communications Manager here at the New Jersey Business and Industry Association. On behalf of NJBIA, I'd like to welcome you and thank you for joining us in person and virtually to today's webcast entitled Social Security Income Strategies Don't Leave Money on the Table. Before we start the program, I wanted to remind everyone that we are recording today's seminar. We ask that you please mute your lines during the presentation and unmute them if you have questions during the Q&A session. You can also feel free to use the chat window at any time during the webinar to ask a question, and when we get to the Q&A, I'll read them aloud. With that, I'd like to introduce Ahluwalia, President of National Security Partners.
Thank you, Vinny. It's a pleasure to be here.
It's a pleasure to have you.
Okay. By way of background, I've spent the last 25 years doing financial planning, and in particular, retirement income planning. But the one area I didn't know anything about was Social Security planning. And I thought, it's just too important a subject in retirement planning to not do a deep dive on. So I thought, I'm going to call all the smart CPAs I know, all the smart tax attorneys I know, even other financial planners, to see what they knew about Social Security. And guess what? They didn't know anything either. And I thought, how is this possible? It's such a ubiquitous benefit, right? Everybody's got it, and yet nobody seems to be an expert in it. So I decided I'm going to become an expert. I'm going to take a weekend and learn. Well, forget that. There's over 2,700 rules that govern Social Security. And most couples have well over 500 possible filing options. And they know one, maybe two. When they retire, they go to Social Security to find out how much they get, or they may have heard if they defer the start of their benefits, they'll get a higher benefit. And because of that, 90% of people, according to the Social Security Administration, 90% of people that file for benefits leave money on the table. So I ended up getting 2 certifications in Social Security planning, invested in sophisticated planning software, started working on hundreds and hundreds of plans. I've done probably a couple of thousand plans now. And in 2016, I won an award. I was named the National Social Security Advisor of the Year by the National Social Security Association, which I thought was a big deal until I went home and told my kids. I said, hey kids, guess what? Your dad won this award. He's the National Social Security Advisor of the Year. And they looked at me like, come on, Dad, is that even a thing? I said, yes, it's a thing. It came with a check, a plaque, and a newspaper announcement. That makes it a thing. But that's when my business exploded. I got published in the Wall Street Journal, Barron, CNBC. I've been on TV, I've been on radio. And what I found is that with 10,000 people a day turning 65, at some point, they've got to make an election on Social Security, and they want to get it right. And that's regardless of how wealthy you are. It's just too important. So today what I'm going to do is I'm going to highlight the major rules that you should understand about Social Security, talk about specific cases, client cases that I have which help illuminate the rules, and also how to integrate Social Security into your overall retirement plan. Because it's a subset of retirement income planning, and for most people, it's their largest retirement asset and they don't realize it. So Vinny, when I speak to new groups, one of the first questions I ask is by a show of hands. I like to ask, how many people have a pension? And I don't mean an IRA or a 401k. I don't even consider them retirement plans because you can outlive an IRA or 401k. You can't outlive a pension. So typically what I'll find is that 10 or 15% of the room will have their hands up. If they have a pension, I'll say, great. For those people that have a pension, how many of those pensions are guaranteed by the federal government, have cost of living increases, have spousal benefits, survivor benefits, children's benefits, divorce benefits, child and care benefits, disability benefits? What am I describing? Describing Social Security. But when I said who has a pension, everybody's hand should have been up because they all have a pension. I don't know what they think Social Security is. It's like, they get a statement in the mail, they look at it, they see some number on it, and they think to themselves, geez, I hope it's there when I retire, and they throw it in the garbage. And that's it. So when you're doing Social Security planning and you see a benefit like that, you have no idea just how much it's going to pay. But I'll tell you this, let's say you have a typical middle-income couple, and they retire at 66.
Just a reminder, please mute your microphone.
Or meeting number, followed by pound.
Okay, so if a couple, middle-income couple retired at 66 and collected benefits to 86, so for 20 years,
Your attending ID number.
that couple is going to get a substantial,
Pound to continue.
you're going to get a substantial amount of money. And how much? Most people think they won't even get $500,000 in benefits but for a typical middle-income couple that collects Social Security for 20 years, they're going to get about $1.4 million. I just did a plan for a couple that was $2.1 million. I have clients collecting $100,000 a year from Social Security, and people have never even looked at it. When they do a financial statement, it's not even part of their retirement assets. It's that significant. So you don't want to drop the ball on the 2-yard line. It took you 35 years to earn this benefit. We want to get it right, and that's what we do. We make sure people don't leave money on the table. So at National Social Security Partners, all we do is Social Security planning. I have a financial planning firm where we do comprehensive retirement income planning. But the one piece that you got to kind of take apart separately and put it under a microscope is Social Security. Okay, so that's what we do. We make sure that you don't leave any money on the table. And that's my background. One Team Financial is a financial services firm that I work with separately. But since so many other financial planners also engaged me to do Social Security plans for their clients, I created this separate company just to do that. So, as I mentioned before, over 90% of people leave money on the table, and part of the reason there's so much complexity to Social Security with all these crazy rules and all these different filing options. But a lot of times when I get referred to clients, one spouse is already been filing and collecting their Social Security. So Vinny, who filed, the husband or the wife? Typically, the husband. Why is that? Well, one thing I've learned after doing a couple of thousand Social Security plans, when it comes to Social Security planning, men are the worst. They're terrible. And here's why. Here's how a man thinks about Social Security. They're usually all fired up. I've been paying into that program my whole life. As soon as I can, I'm going to get my money. What if I defer the start of Social Security and I die young and I don't get my money? My answer is this. If they defer the start of Social Security and die young, all right, they're dead. Right? So the thing is, when it comes to Social Security planning, the risk in retirement is not dying young and not getting your money. The risk in retirement is living too long and outliving your money. Okay? So when a man, and it's typically a man that does this, files early, not only are they getting a reduced benefit, as a couple they're getting a reduced benefit, but they've also reduced the survivor benefit for their spouse. When you do Social Security planning as a couple, you always have to think about, at the death of the first spouse, the survivor gets the higher of the two checks, but not both. So if the husband takes the benefit early, it's also reduced the survivor benefit for his wife. And why is that a big deal? Well, because women still live longer than men, right? When you're thinking about Social Security, and I've written articles on this, Social Security is really a woman's issue. And the reason I say that is women outlive men. Typically, not always, but typically their benefits are lower because maybe they didn't work their full career and get earnings recorded for Social Security. They may have stayed home raising kids for a few years. So if their benefits are lower, they do depend on that survivor benefit. You know, the leading cause of bankruptcy in retirement now is long-term care insurance, right? Men are kind of lucky. When men get old, they drop dead, all right? But women linger, and lingering is expensive, right? You go to any nursing home, 3 or 4 people are women, the men are dead. So the cost of retirement can get very heavy later in life. So maximizing Social Security could be very important in overall retirement planning. So one of the first questions I get when I meet people and we talk about Social Security, they want to know, is it even going to be there when they retire? And what's interesting about Social Security, they actually tell you the year they expect to run out of money. And they just updated that. The year is now 2035. Think about it. When I speak to CPAs, I try to impart on them how big Social Security is. I say, listen to me, the Social Security Administration is bigger than the IRS, okay? They pay out over $3 billion a day. 70 million Americans get a check every month from Social Security. So the program, right now, if they make no changes, is expected to run out of money in 2035. But what does that really mean? What it means is, if you're retired, it's 2035, you open up the paper and it says the Social Security Administration just ran out of money today, what happens to your check? Do you still get it? The answer is yes. You'll get about 77 to 80% of that check, if they make no changes. But they're going to make changes. They have to make changes. For the viability of the program, they're going to do certain things. Now, what can they do? Well, they can cap the cost of living increases or eliminate them. They can means test Social Security. They can raise the Social Security taxable wage base. There are so many things they can do to make sure that the program survives. And it has to survive. And one of the reasons it's going to survive is politically, right? You can't run for president, go into Florida and tell people you're going to cut Social Security. That's not going to work. So the program's going to be there. And the reason I'm focused on this is when you do retirement income planning, do not assume the Social Security is not going to be there in retirement. It's going to be part of your retirement plan, and you want to make a smart decision about it. And you want to know if there are ways to maximize your benefits, do it. Don't leave money on the table, but it's complicated. One of the goodies Social Security still offers is cost of living increases. All right, so let's say your check was $2,000 a month and the cost of living increase was 2.7%. This year, by the way, it was 1.6. Last year it was 2.8. The 20-year average is about 2.5%. But if you had a $2,000 a month check, and in 10 years, with that cost of living increase, your check would increase to $2,600, and in 20 years to $3,400, and in 30 years over $4,400, but that doesn't really resonate with people, but I think this does. That $2,000 a month check with cost of living increases in 10 years will pay you over $300,000 in benefits. And in 20 years, over $660,000. And in 30 years, over $1.1 million. And that's one spouse. So you're going to say, but Ash, who's going to get 30 years of Social Security checks? Well, do you know anybody in their 90s? You know, I was just at a 100th birthday party for a client of mine. I went to this hotel. I went to the front desk. I said, I'm here for the gentleman who's having his 100th birthday party. What did they say, Vinny? They said, which one? Okay? Because that's what's happening. People are living longer and longer, and a pension, especially a rich pension like Social Security, is critical to get right. Your benefits are based on your highest 35 years of indexed earnings. So if you work for 20 years, and that's all you have recorded, they're going to look at 20 years of earnings plus 15 zeros. It's going to drag your benefit down. So every zero you can replace with an earning, you can increase your benefit amount. So just understand that every single year increases your benefit. So they take the highest 35. And by the way, even if you're collecting Social Security and you're still paying into it, they'll increase your benefit amount even though you've actually started receiving your benefit. So there are a lot of opportunities to max out your benefit. Now, to qualify for your own benefit, you need 40 quarters or 10 years of earnings. Okay, it's so important because a lot of times when I get a new client, I'll call, let's say last week I had a doctor, and he said, yeah, I want you to hire you to do my plan. I'll send you my statement. I said, well, send me your wife's statement. Did she work? Yeah, she worked for a few years, but she doesn't have a benefit. I said, well, send me your statement anyway. He goes, she doesn't get any. I said, just send me your statement. He sends me her statement. She has 39 credits. I said, are you kidding me? She works in your office. Pay her once. If she earns $1,410, she'll get a $500,000 pension. She will receive those 40 credits. I see those statements all the time. 35 credits, 37 credits. People don't realize because when they get their statement, it says your benefit's zero. Well, it's zero, but for $1,400 earnings, you're going to get a $500,000 pension. Now, full retirement age is critical. The actual full retirement age for everybody depends on the year you were born. So if you were born between 1943 and 1954, it's 66. If you're born after 1960, it's 67. And every year in between, they add on a couple of months. So why is that such a big deal? Well, if you file even one day before your full retirement benefit, or full retirement age, that may cost you $100,000 in missed benefits because there's so many things you can do at full retirement age you can't do before that. So the big deal about full retirement age is that's the first time you can file for your Social Security benefits, and it doesn't matter how much you earn. In other words, if you file from 62 to full retirement age, if you make more than $18,240, every $2 you earn above that, they take back $1 of Social Security. Once you get to full retirement age, you can file, collect, they don't withhold anything regardless of your earnings. But because Social Security can't make anything simple, there's usually more than one full retirement age. And you say, how is that possible? You're only born once, right? You should only have one full retirement age, but you could have more. I just had this case a few weeks ago. My client, she's 65. She's a widow. She was born in 1956. Her full retirement age is 66 and 4 months. She's eligible to collect a survivor benefit, but because she hasn't reached her full retirement age and she's still working, she won't be able to collect any money because of her earnings are too high. So she has to wait till her full retirement age. But guess what? There's a different full retirement age for survivor benefits. For someone born in 1956, the full retirement age is 66. So that means she can start collecting that $3,000 a month check 4 months early. And I know what's going to happen. She's going to go into Social Security at 66 to file, and they're going to say she's not eligible at her full retirement age of 66 in 4 months, and they'll be wrong. They're wrong all the time, okay, because there's so many crazy rules. But she's entitled, and if she doesn't have an advocate, she's going to miss out on that $12,000. If you file for your benefits early, you get a permanently reduced benefit. You can file as early as 62, and if you're retired, you don't have earnings, they'll start paying you, but you'll get 25% less permanently. Now, I do plans for the New Jersey teachers, and if they retired at 62 and took their pension and then went to Social Security to take this pension, they get a permanent 25% reduction in Social Security. And I can tell you, if their pension was $1 million through the teachers, they're not going to take a 25% permanent reduction in that benefit by taking it early, but that's what will happen here if they file for Social Security early. On the other hand, if they defer the start of Social Security, their benefits are guaranteed to increase by 8% a year plus cost of living. So if you defer the start of Social Security from 66 to 70, you can get a 32% permanent increase in your check for the rest of your life. But the question is, how long will it take for that higher check to recoup what you could have collected those 4 years? And that's why you have to run the analysis, look at break-even points, look at lifetime benefits, look at so many other factors. That's the earnings test, the $18,240, again, between 62 and the year that you reach full retirement age, the earnings limit is $18,240. The year that you actually reach full retirement age, it's $48,600. So you're allowed to earn more of that 1 year. And so you could file even earlier than your full retirement age. The grace year rule, this gets confusing. The very first year that you file, there's a grace year rule, an exception rule. So let's say this person retired in July of this year. But from January to June, they made $100,000, and then they retired. Well, they're well above the $18,240 because they made the $100,000. Are they eligible to collect Social Security this year? Well, yes, they are, because Social Security doesn't look backwards. They just want to know from July 1st to the end of the year, are you going to have any earnings? And if you're not, they'll start paying you even though you well exceeded the earnings test already. Technically, what they do is they go to a monthly test. The $18,240 divided by 12, $1,520. If you keep your earnings under $1,520 a month, from July 1st to the end of the year, they won't withhold any benefits. Because Social Security is not complicated enough, they changed the rules in 2015. They took away some goodies like filing and suspending. But here's the big deal, and that is the spousal benefit. Okay, now people don't realize there are two different spousal benefits. One of them they're phasing out, but the other one is still there. So the spousal benefit that allows you to collect half of your spouse's benefit and defer your own, that's called a restricted application for spousal benefits. But to do that, you have to be 62 or older as of January 1st, 2016. If you were not, you can't do that. But the second spousal benefit is still there. And what that says is this: you're always entitled to the greater of your own benefit or half of your spouse's benefit, regardless of when you turn 62. Okay? So I'm going to go through some examples and explain that. So here's a basic example for a spousal benefit. Let's say John and Jane, their PIA, which is their benefit amount at full retirement age. If John's is $2,000 and Jane's is $800, if they both file, what's Jane going to collect? She's going to get the higher of $800 or half of John's, which is $1,000. So she's going to get $1,000. So if she's going to get $1,000, why do I care that she has a benefit of $800? Well, the reason I do is because what if she decided to file early at 62? The $800 is reduced by 25%, but that extra $200 is reduced by 30%. If she defers her benefit to 70, the $800 grows at 8% a year, plus cost of living, but not the $200, okay? Because her benefit can never exceed half of John's full retirement age benefit, half of the $2,000. Backdating an application, this happens quite often because when people come to see me, a lot of times they pass their full retirement age and they want to know, geez, can I go back to my full retirement age to collect? And the answer is, the most allow you to go back is 6 months or your full retirement age. So here's an example. Let's say it's January 2020. The husband here turned 66 last July, okay? If he had filed last July, his benefit would have been $2,700. His wife's already collecting. She's 68 and she's collecting $950. So the question he said is, should I file now, January of this year, and get a 4% higher benefit amount, right, because 6 months have passed? Or should I backdate my application to July and collect the 6 months that I missed? So here's the calculation on that. All right, we'll try that. Okay, so if he files back in July, okay, he's going to get the $2,700. If he files today, let me go back to this one. If he files today, he's going to get $2,800 a month, 4% higher. But as soon as he files now, in January, his wife's going to be entitled to that spousal add-on. Remember, she's entitled to the greater of her owner, half of his. Well, half of his is $1,350. She's getting $950. She's going to get an extra $400 a month. Now, do they automatically pay her? Well, of course not. Social Security doesn't automatically do anything. You have to go and ask for it. So until he files, she was not eligible. So even though she's collecting, she still has to go with him and say, now that my husband's collecting, I want my extra $400. And then they'll pay her. I've had clients miss that for 20 years. It's ridiculous. But let's say he backdated his application 6 months. If he did, he'd get $2,700 a month, which would pay him a lump sum of $16,200. Well, because he backdated his application 6 months, she can backdate her spousal add-on 6 months. She can get another $400 a month for those 6 months. That's $2,400. So combined, believe it or not, combined, Social Security is going to write him a check for $18,600 as a lump sum, start paying her $1,350 a month, and start paying him $2,700 a month. So this is a client of mine. His wife got early onset Alzheimer's at 63. He's 67. So they decided before they met me that it was better that she files early, take a 20% reduction, but since her life expectancy is shorter, she might as well get as many checks as she can. But he knows this. He's going to be living on one Social Security check deep in retirement, and that's his own. So he's going to defer his to 70, max it out, and then take his. So they asked me, Ash, was that the smart thing to do? And I said, I think that's fine. I said, but what about your spousal benefit? He said, they didn't say anything about a spousal benefit. I said, they're not going to. That's how Social Security works. Because your wife's collecting, you're entitled to collect 50% of her benefit, and not of her reduced benefit, 50% of what she would have gotten at 66, until you're 70. So go back in there. That turned out to be $15,000 a year, so $45,000 he was entitled to that he would have missed, for sure. Okay, maximum versus the sweet spot. When I started doing Social Security planning, I assumed that all my clients wanted me to find them the most money. Logically, right? Isn't that way? And I do that, by the way. Of all the things that they can do, I said, look, there's no way to get more money than this. This is your maximum lifetime benefit. But what I learned is, over 95% of the time, my clients do not pick the strategy that pays the most. And they shouldn't, because it's almost never the best. He said, why is that? Why would you want less? That's because it's not just about how much money you get, it's when you get it, right? How long does it take you to recoup the money you could have already collected? What if they changed the rules? What if you didn't live to 90 or 85? What if you died young? What would happen? So here's an example of a client of mine where we did that. John, 67, still working. He's got a benefit $2,600. Mary's a retired attorney at 63. Their benefits are similar because everybody in their family lives to 100. We assumed they would both live to 90. And if they did, my software is automatically going to say, defer to 70, max out your benefit, collect that for 20 years. That's how you get the most money, and it is. But the question is it the sweet spot? Is it the best filing strategy? So if they defer to 70, their combined lifetime benefit is $2.1 million. But I said, let's consider this. What if Mary files early and takes a reduced benefit at 63 instead of the max at 70? Well, why would she do that? Well, if she files at 63, John can collect half her full benefit until he's 70 and then take his. And over their joint lifetime, they'll get $1.99 million, $110,000 less. So why is $110,000 less better? Well, it might be if you look at all the other factors. If they both wait to 70, under the sweet spot strategy, they would have already received $186,000. Right? What if John's driving to Social Security at 70 and gets hit by a bus? Well, Mary will get his higher benefit amount because he waited to 70, but she's not getting $186,000. How much more are they really going to get over their lifetime? $110,000? When is that? Not for 27 years. What's $110,000 worth today? If you get it in 27 years. 40, 50,000? What if you don't live to 90? What if somebody gets sick? What if they change the rules? What if they cap or eliminate cost of living increases? What if they means test Social Security? So you have to risk affect these cash flows. You can't just look at plug and chug what pays the most, because for the most part, it's not the best. You got to look at all these other factors. Same-sex couples are eligible for all the same Social Security benefits as heterosexual couples, right? In 2015, it became a national program so that I have probably a same-sex couple call me once a month now because it's the first time they've been able to plan for spousal benefits, survivor benefits, children's benefits, all the same benefits. Divorce benefits. This is almost bankrupting Social Security. Why is that? Well, because the divorce rate's so high. So Vinny, what's the divorce rate on first marriages? Approximately?
A lot.
A lot. Okay, good. When I speak to a room full of people, I said half of you should know this, okay, because it's about 50%. What about second marriages? Who thinks the divorce rate's higher for second marriages? The actual divorce rate for second marriage is 68%.
Okay, I'm
right?
surprised.
Now, some people were married 3 times. So what do you think the divorce rate is on third marriages? You think it's higher or lower?
Lower.
74%. There's no learning curve here. None. Okay? And because the government is losing billions of dollars, they did their own research to figure out why the divorce rate's so high. You know what the leading cause of divorce is? According to the government, it's still marriage. Just saying.
Har har.
All right. Now, divorce benefit rules are so complicated, but there's some basic rules, okay? Your marriage had to last at least 10 years. You have to be currently unmarried. You and your ex have to be at least 62, and you have to be divorced for at least 2 years. Basic rules. So many exceptions to this rule. You know, I wrote an article for the New Jersey Law Journal on divorce benefits because there really isn't a matrimonial attorney in the state that could write that article because Social Security is not an asset you carve up in a divorce, right? They can carve up the 401k, but what do you do about Social Security? So they don't really know those rules. So here's an example. My dentist, he's 67, he's divorced, not remarried. He's like, Ash, what's the big deal about Social Security? I'm still working, I do well, I'll wait to 70, max out my benefit. Done, there's my plan. I said, so you think that'll get you the most money? He goes, yeah, what else can I do? I said, well, you're 67, you can start collecting half of your ex's benefit amount. He says, she'll kill me. He says, it's got nothing to do with her. You go to Social Security with your divorce papers, they look up her benefit, start sending you checks equal to half of that. Doesn't take any money away from her. And she can collect half of your check if she didn't remarry. But my doctor, she's 61. She's divorced. Under the new rule, she can't do that because her own benefit's more than half of her ex's. Well, what if she wasn't my doctor? What if she was my neighbor and she had no benefit? She was a homemaker. She could still collect half of her ex's benefit, even though she wasn't 62 as of January 1st, 2016. This poor woman was married for 9 years and 9 months. She said, is that a problem? I said, yeah, that 3 months that you weren't married cost you about $500,000 to $1 million. She had no benefit of her own. She could have collected half of her ex's or 100% if he predeceased her. All right. This couple married each other twice and divorced each other twice. Okay, so for a 10-year period, they were married except right in the middle for 18 months. So in total, they were married for 8.5 years. Are they eligible for divorce benefits? The answer is yes. Why? Because there's another exception. The exception says if you remarry the same person by December 31st of the following year, you're deemed to be married in each of those years. So you qualify. So what does that tell you? Well, Vinny, what it tells me is there was a congressman who had this situation, right? Because this should not exist. If you get divorced, you're not allowed to collect off your former spouse. But there are a lot of exceptions. Survivor benefits. At the death of the first spouse, the survivor gets to hire the 2 checks. So if Joe predeceases Julie, she'll switch from her $1,200 check to his $2,000. If Julie goes first, Joe just keeps collecting his. So my client Joe, he's a widower. He's 63. He's collecting a reduced survivor benefit. And I say a reduced because you can collect survivor benefits as early as age 60, but you get 28.5% less. So Joe filed early, gets a reduced survivor, but he has a girlfriend, Lori. She's 59. She's a widow. She can't collect survivor till she's 60. So what's the problem? The problem is they want to get married. They said, Ash, can we get married? I said, no. What I really said was not yet, because if you get married now, Laura, you won't be eligible to collect survivor when you turn 60, and Joe will lose his survivor. But if you wait till you're 60, you go in and file at 60, start collecting your survivor. If the two of you get married, you can both keep collecting off your former spouse. Why is that? There's another exception. The exception says if you remarry after age 60 and your former spouse dies, you're allowed to keep collecting off your former spouse. Another exception. See it all the time, actually. Self-employed business owners. If you're a business owner, oh my goodness, you have so many other opportunities to do Social Security planning. So here's an example. This husband and wife have a business together. They do very well. He's 67, she's 64. He pays himself $300, pays her $100. He's saying, geez, you know what? Maybe I should start collecting Social Security now. There's no earnings test. I can collect it. So I said to him, well, we're going to run a lot of different scenarios, but here's something we're going to consider. Why don't we stop paying your wife $100, pay you $400, pay her nothing? Well, why'd we do that? Well, she's paying Social Security tax on her $100. She's paying $12,400 a year. Social Security tax, 6.2% as an employer and an employee. But if you receive it, you don't pay any Social Security tax on that because the wage base is $137,700. Any earnings above that, they don't charge Social Security taxes on. So that saves you $12,400 a year. But because she has no earnings now, she can file and collect her reduced Social Security benefit, and you can start collecting spousal off of her and defer your check. So now you're going to get 2 new Social Security checks and save $12,400 a year Social Security tax. And there's no software that does this. As a financial planner, I look at everything, right? Not just the Social Security rules, but how to fit it into your overall plan. College funding. Will Social Security pay for college? Absolutely not. But maybe my client, he's 66. He's an attorney, second marriage. His wife's 10 years younger, but they have a 14-year-old child. And he's thinking, oh my gosh, I got to put this kid through college. Maybe I should take Social Security now. There's no earnings test. I can collect the $2,600 a month, take that $30,000 a year, put it into a 529 plan for 4 years. Should I do it? I said, I don't know. See, here's the problem. If you file at 66, your wife's 10 years younger. She's going to outlive you by 15 years. So you reduced her survivor benefit. On the other hand, if you do file, your child is also eligible to collect a benefit. He says, how much? I said, an amount equal to 50% of your benefit. On top of your benefit, that's $1,300 a month, $15,000 a year for 4 years. That's $60,000. Who else can collect? Well, since his wife has no earned income, she can also collect 50% of his benefit for a child in care benefit for 2 years. That's $15,000 a year for 2. That's another $30,000. So that's $90,000 he would have missed if he just went in and filed for his own benefit. Just saying. This is a wild story. This poor guy was married 4 times and then he died, mercifully. Okay, but this is his third wife, who's 35, much younger than him. They were only married for 6 years, but they have a 5-year-old child together that she's taking care of. So if he goes into Social Security at 62 to file, is the child eligible to collect anything? And the answer is yes. The child's eligible to collect 50% of the full benefit he would have got at 66, not the reduced that he's going to get at 62. So that child gets $15,000 a year from age 5 to 18, 13 years. That's a couple of $100,000. What about the ex-wife? Can she collect anything? No, because they're divorced. Well, what if they were married for 10 years? Could she collect anything? No, because they're divorced. But what if on the way to Social Security at 62, he gets hit by a bus and he dies? Then what does the child get? The child then gets 75% of his full benefit until the child's 18. And now his ex-wife can collect a survivor child in care benefit equal to 75% of his benefit until the child's 18. So all we want to know is who was driving the bus, right? Because it was her anyway. Okay. President Trump might be getting 3 Social Security checks. Now, why would that be? 3 years ago when he was 70, I don't know if he filed, if he did, but let's say he did. If he filed at 70, Barron was only 10. As soon as he filed, Barron could collect 50% of the benefit he would have received at 66 until Barron is 18, 8 years at $15,000 a year, right? $120,000. And if Melania had no earned income, she could also collect child and care benefits equal to 50% of his benefit until Barron was 16, right? So 6 years. That's another $90,000. That's over $210,000 on top of his check. Estate planning. You know, my clients that are very wealthy, and I mean like 20 million to 100 million, you would think they wouldn't care about Social Security. I can tell you all those people want every dime. They hound me about Social Security. They want to get it right. They don't need it, but they want it. They paid into it, and they're entitled to it. But their needs are different. Like this guy's worth $80 million. He doesn't need Social Security to substantially change his lifestyle. It's not going to do that. So most of his advisors would say, you don't need it. Why take it now? You're just going to pay taxes on it. Wait to 70, max it out, then take it. And I tell him do the exact opposite. I said, this guy's big problem is estate taxes, right? If you're worth over 22 million, you're going to pay a 50% estate tax, federal and state. So I tell him, take the Social Security early, pay the income tax on it. So the $50,000 is going to net 35, gift it into a trust. It buys about $2.5 million of life insurance. Now you have Social Security paying your estate tax. I had a surgeon in New York. He wanted to leave $2 million to his grandkids. I said, great, let's get Social Security to pay for it. We take his Social Security early. We use that to fund $2 million of life insurance and a trust for his grandkids. So it's just another asset there for retirement, and you have to say, for you and your situation, what's the best and smartest use of that Social Security income, and how do you maximize it? Is Social Security subject to income tax? People have no idea, quite frankly. And the answer is it depends. They calculate something called provisional income. So they look at your adjusted gross income, half your Social Security benefit plus muni bond interest. If you're married filing jointly and that adds to more than $44,000, you have to include 85% of Social Security as ordinary income for federal taxes, 15% tax-free. But it's never subject to state income tax. So it's really a tax-favored investment compared to, say, an IRA distribution or something. If your AGI is low or you don't have one, then Social Security is tax-free, right? Because your provisional income is going to be under $44,000. So the answer is it depends, but for most people, you're going to have to include 85% in your federal income tax. There are some Medicare gotchas tied to Social Security, and you're going to say, what does Social Security have to do with Medicare? Well, I just had this case. This gentleman, 66, still working on his health insurance plan at work, contributing to an HSA. He's collecting a spousal benefit off of his wife. So what's the problem? He's not on Medicare because he still has group insurance at work. But as soon as you collect a Social Security benefit, even if it's a spousal benefit, they automatically sign you up for Medicare Part A. Well, Medicare Part A is free, and he has group insurance, so it's secondary. So what's the big deal? Well, the big deal is this. If you're on Medicare, you can't contribute to an HSA anymore. So if he kept contributing, he'd have to pay a penalty for those contributions, and it would be taxable. And he's like, but I didn't sign up for Medicare. No, but when you sign up for Social Security, they sign you up. So that's a gotcha. And COBRA is not creditable coverage. So if you're on COBRA and you're past age 65, you have to sign up for Medicare. And every year that you're late, there's a permanent 10% penalty on your Medicare Part B premium for the rest of your life because you signed up late. Every year you're late, there's that penalty. You have to be super careful. So we look at a whole bunch of factors when we determine what your Social Security sweet spot is. And I can tell you, if I have a couple, same age, same benefit amount, I can almost guarantee you I'm going to make a different recommendation to them because they're all going to have different life expectancies, different amounts of savings. Some will have life insurance, some won't, long-term care. Their tax brackets are going to be different. There's a whole host of other factors that determine what your personal individual sweet spot is. Okay, so what we're going to determine is what's the best age you should file, you and your spouse should file. What other filing strategies are available to you? Okay, is it easier to file online? Is it easier to call Social Security? Is it easier to go into an office? What's the best way to actually execute your Social Security plan? And if you have problems, if you go to Social Security and they tell you you're not eligible for benefits, then what do you do? How do you get the code sections? Okay, so that's what we do. We empower our clients. We make sure that after a lifetime of earnings and savings, that they get every dollar they're entitled to in Social Security, and more specifically, that they find out what their Social Security sweet spot is. So if you have other questions and you want to contact me, you can go to my website, www.nsspartners.com. That's nationalsocialsecuritypartners.com. You can contact me directly at 973-202-1212, or you can email me at ahluwalia@nsspartners.com. But call me or go to the website. That's probably the easiest way to contact me. Thanks, Vinny.
Thanks, Ash. Let's open up the Q&A. If you'd like to ask a question, the lines are open. We just ask that you please say your name and organization. You can also type something in to the question box, and I'll read them aloud. for such a complicated topic, it looks like you explained this perfectly. No? I have a question.
Okay.
So I did the math when you were talking about the year that Social Security is supposed to run out.
Yes.
And I'm going to be 53 when that happens. But you said that in all likelihood, I'd still get some money. Where does the money come from if they don't have any?
Yeah, that's a great question. Well, really, Social Security is, for the most part, funded by tax receipts. It's not by the money that's in the Social Security Trust Fund. So right now, we just at a turning point where more money is coming out than going in. But as long as people keep paying their taxes, right, there's still going to be money coming into the Social Security program. So that's where the money's coming from, just from tax receipts.
Okay. Howard has a question. He asks, at what age should you start looking into what your strategy ought to be?
Howard, that's a great question. Typically, my clients are in their late 50s to 70. So 55 to 70, but probably late 50s. Sometimes my clients in their early 50s do. They want to know because they're doing overall retirement income planning, and they want to understand what their Social Security benefits are going to look like. Now, sometimes there's an age discrepancy among couples. So maybe one spouse is 65 and the other is 57. But if you have one spouse that's 62 or older, that's still an important time to start looking at planning.
We have a real softball question for you here. They want you to just repeat your contact info real quick.
Okay, so the website is www.NSS, that's Nickel Sam Sam Partners, plural.com. You can call me directly at 973-202-1212, or you can email me at Ahluwalia, so that's AAHLUWALIA at nsspartners.com. And I do offer complimentary initial phone calls, so if you have questions or you want to discuss your situation, I'd be happy to speak with anybody.
Cool. So I have a question here from Roberta. She's 61, and she says, if your income is not steady, should you use your own savings to get to the full retirement age? Is it best to use your savings to pay for bills and wait until 70?
Yeah, that's a great question, and never a simple answer. Depends what your earnings are going to be. But here's the thing. Let me explain the consequences. If you filed at 62 and then you had years where your earnings were too high, what would happen to your Social Security benefits? Let's say I had a client, and I'll simplify. Let's say I had a client who lost their job at 61. And at 62, they said, well, I don't have earnings. I can go collect Social Security now. So at 62, they file. And then at 63, they get a job again. And now they want to turn off Social Security. Well, you can't suspend Social Security prior to full retirement age. But because your earnings are so high, they're going to withhold all of your checks from 63 all the way to your full retirement age, 66. So in that case, he would have lost 3 years of Social Security checks. So what happens? What happens is when he turns 66, Social Security knows they only paid him 1 year early. So they're going to recalculate his benefit amount as if he had filed at 65 1 year early. So if you have variable income from 62 to full retirement age, all those months that they're going to withhold, they're going to add those months up and they're going to recalculate your benefit at full retirement age. So you're going to get your money back, but you're going to get it paid out over your retirement.
Any last questions from the audience? You feel free to unmute your mics and chime right in or type them into the questions box. All right. Well, I guess that's all the questions, so it's as good a time as any to bring things to a close. I hope you enjoyed the webcast today. I'd like to take this opportunity to thank ASH and the National Social Security Partners for their partnership in today's program and wish you all a great day.